This conference will now be recorded.
Hello, everyone. Thanks for tuning in. Just to give you a brief summary, this is going to be the first of hopefully a long series of podcasts that we're going to be providing for your information. Today, we've got some strategic partners from Blackrock. I'm going to turn it over to Patrick LeBlanc here in a second to give an introduction. Hope you enjoy.
Yeah, thanks, Jordan. Certainly thanks for having Blackrock as guest speakers. Just wanted to introduce the firm very quickly and really discuss why this matters, right? So some of you may know Blackrock. We are truly the world's largest asset manager. But I think what's very unique about Blackrock is we have 35 offices and 16,000 employees, and more than half those employees today are overseas. Right, and as this podcast or this discussion today is going to focus on emerging markets, I think that gives us very unique insight. It gives us access to truly global markets when you think about that. But also, as you'll learn as you talk to our featured speaker from Blackrock, DiPrimio, you're going to hear about access to information flow, right, and access to how dynamics in emerging markets are changing quite quickly. And so think about those two things as you listen to Chris and Jordan's discussion today. That's what I would ask of you. And so that I'm going to kind of turn it back over to you two to have a discussion on emerging markets and what it means today.
Thank you so much for that, Pat. So Chris, I think a natural place to start, this is going to be a question that I'm going to let you riff on, if you will, because it's a bulky question, but give us your summary on where EM stands right now, why it's an attractive place for investors to be putting money into, and where you see it evolving in the future.
So thank you. First of all, let me just say thank you, Jordan, for letting me speak on this. Pat, thanks for asking me to help represent Blackrock with you on this conversation. And let me also extend, because it's not yet February when we're recording this, Happy New Year to everybody who is paying attention. Hope everyone is staying happy, healthy, and lastly, sane as we kind of make it through month 11 of our quarantines. But as we think about the recovery that is expected, and the vaccine deployment, and all this idea of growth and cyclicality coming back to the market, this modality of synchronous growth globally, there is a strong case to be made for emerging markets, emerging economies. It's interesting. We hear all the time, I like emerging market value plays. I like emerging market debt plays. I like emerging market core plays. Emerging markets are growth, right? So no matter what style you're trying to approach the space with, it is a growth style of asset. Now, what's interesting is you've seen a massive evolution, and part of that was a secular trend that began pre-COVID that you've really seen kind of go on steroids over the past year. And that is the concentration of market cap and performance, as well as the economic heft of Asia emerging markets. And if you look at market capitalization right now, from an EM perspective, 80% of it is actually within Taiwan, South Korea, and China. So the concentration of market capitalization is firmly within the Asian economies. A lot of that was driven last year because of the viral trends. And if we had looked at just some of the spread of coronavirus itself, we all know what the cases have been like here in the States. We've heard the headlines from Europe. By and large, within Asia, they did get this thing under control. And we can question the data on a different conversation. I'm not here to make a government data out of China conversation. But if you look across just even Australia, Singapore, South Korea, et cetera, the virus was better under control, which allowed them to recover much, much stronger. And so you saw that in market performance. You certainly saw that in economic performance. And China was the only large country last year that actually had a positive GDP print. So why did we go through this? Because the old adage for emerging markets was the BRICS. It was Brazil, Russia, India, China. It was, you wanted to try to identify the various economic exposures and kind of cyclical exposures that people wanted to get access to. It was resource heavy. For Brazil and for Russia, it was energy, right? It's oil and gas. For China, it was labor as the major resource. But the evolution that we've seen over the past decade has been that China is really no longer a labor resource economy. It is a consumption and domestic demand-led economy. And if you look at their GDP print, the majority of their GDP is driven by internal consumption. The evolution that they've actually made, which usually takes economies several decades to achieve, they've actually been able to do it in a matter of years. And it's something that we have to take note of, because what it's implied is that China realistically is no longer a developing nation or what would be qualified as an emerging economy. It is without doubt a developed economy. It's the second largest economy in the world, probably going to overtake the US here over the next 10 years, within the next 10 years, I should say. Unbeknownst to all of us here in the States, is the second most liquid stock market in the world. There is more liquidity in the market in China than there is for the entirety of continental Europe and for Japan. The only market that has more liquidity and more listed entities is the US. And this develops a thesis that my team believes is very, very important, as well as what we've seen with our institutional clients, which is you're going to start to see a carve out between China and the US and the rest of the world. So one of the big trends that we've seen, and we run Chinese mandates for a lot of large entities, the World Bank, the UN, et cetera. What they do is they create what's called GEM X China, so Global Emerging Markets X China. They're still running a global EM portfolio, but they're taking China out of it because they don't view it as an emerging economy anymore. And then they're hiring a very specific Chinese allocation. And it's not going to be a Hong Kong listed entity, which you're already getting in your global mandates. It is a specific allocation to the China A-share developed market. And we think this is going to start to evolve here in the States to look very similar to how investing was done back in the 80s, where you had your US allocation, you had your Japan allocation, then the rest of the world. We think going forward, it's going to be US, it's going to be China, and then it's going to be the rest of the world. And so this is without doubt a pretty sizable evolution of the economy and the marketplace, and certainly something that everybody has to pay attention to. And if you want to capture a little bit of that trend, we were catching up right before the recording, Jordan. We were talking about the amount of market capitalization in global emerging market indices that is allocated to China, which is about 40%. They are going to continuously include a greater proportion of local China A-share securities into that market. It is going to be a technical beta trend. And so there is certainly a risk associated with it, but there's going to be a wall of money kind of moving into that space. And from our perspective, if you have two stacks, you have an economic stack, a political stack, and a technology stack. Here in America, we only own one of those, which is the US. It does make sense to think about owning both of those global leader stacks between the US and China.
So when you talk about owning EM or owning China, I know you've mentioned some funds specifically, but for an investor to get exposure, are you buying Alibaba, Tencent, Taiwan Semi and calling it a day? Or what's the best way to get access from a broad investor standpoint to not only China, but EM in general?
Yeah, so it's interesting, right? The Alibabas, Baidus, Tencents, I mean, they are no longer what we would think about as local China economy. And this is part of the evolution of that market. 20 years ago, if we were going to invest in China, 75% of your allocation would have been in what's called a state-owned enterprise, right? It would have been very big financial companies. It would have been CNOOC, which is in the media right now, which is an energy organization. The big thing to us is the newcos. So 75% of listed entities today are actually private entities within the Chinese economy. It's healthcare organizations, it's discretionary companies, it's technology companies. It's not state-owned enterprises. And that to us represents the big opportunity. The challenge has always been, to the point of the question, how do you access it, right? Historically, it was what was called a QFII quota. So you had to apply for access via a volume limitation with the government to be able to invest in those companies. The difference today is that you actually have Stock Connect. And if anybody's heard about this, it's kind of the northbound, southbound connect between Shanghai and Hong Kong listed entities. But today what we can do is now everybody has been able to democratize that access, and you can invest directly in those China A-share securities, whether it be through kind of a passive ETF strategy, tracking an index like an MSCI China A, whether it be in an active solution where you can really go in with speed and technology to deliver a lot of alpha. You can get access to it, not directly buying those securities, but through different vehicles that are available for investors. I will say, admittedly, and certainly from a Reg FD perspective, I sit and work on a portfolio team that runs active solutions. The area that we're most excited about from an active management standpoint is going to be in China. And one of the reasons why that's the case is the information in that marketplace is so diffuse or difficult to come by that if you can get it pretty interestingly, it's going to give you this opportunity for alpha. And it's definitely one of those few remaining markets that exist in the world today where alpha really does come in bunches. In other words, the outperformance above some sort of beta or benchmark measurement. Also, I would say that exists for broader emerging markets as well. So a lot of the active management solutions that exist in the marketplace today, whether they're BlackRock or otherwise, what you typically notice are a few themes. One is if you dip down in market cap or go towards smaller companies, you see a lot of alpha delivery. The other is looking abroad and looking towards smaller economies, where it's more difficult to access management teams in those in those various regions or countries. And certainly, if you can go in there with a speed and a technology base, you're able to deliver some outperformance over time.
Sure. Now, we can't talk about pretty much any investment theme, let alone EM right now, without talking about the COVID story and the vaccine story. Breaking it down into short, intermediate, and long term, what are some of the risks and opportunities EM, again, in the short term as it relates to vaccinations? I think we can all agree longer time for these emerging market economies to be widely vaccinated, to be back on track to pre-2020 levels. Give us your take on some of the risks inherent in those 3 time horizons.
So the thing that I would say about the risk from an immediacy perspective is certainly headline based. And if people believe that the recovery is going to be extended past what had happened when Pfizer and BioNTech came out with their efficacy data on November 9th, you are going to expect to see a correction, right? The correlation of emerging economies, China, whatever it may be, to pure growth is extraordinarily strong. And that growth is tied inextricably to a belief that the recovery is going to be broad and earnest. So I think headline risk is certainly something that is going to affect and can affect the near-term performance of emerging markets. Part of that is, the variance, right? So it's not just about the vaccine development. A lot of emerging economies are tied to the developed markets' performance and recovery. You can almost imagine, if our supply and our demand increases here in the States, think about the integrated global supply chains that feed into that. That bodes well for Asia EM economies, especially when you think about things like Apple, which had blockbuster numbers that came out the other day. So you need to kind of have this belief in the recovery for a sustained performance in emerging markets. I'm not a clairvoyant when I think about the viral trends, but certainly the case can be made that it's going to be volatile in the near term. And that's okay, by the way, that's okay. Volatility is a good thing for the markets. It's actually a dollar cost averaging tool that can help all of us as we're trying to accrue wealth long term. What I would say over the longer term profile though, and why emerging economies are important, just look at the population trends. 80% of the world's population are in emerging economies. 80% of the population are in emerging economies. But you have 80% of global market cap dominated by developed economies. Excuse me. So you have kind of there's always the 80-20 rule, right? So you have most of the global market cap dominated by countries that only have 20% of the global population. As more and more consumerism comes online, as more of a middle class begins to get developed and economies are moving away from just a resource-led economy to a consumption-led economy, you have an enormous opportunity to kind of ride that wave. So if you have a longer term horizon and you need growth exposures in your portfolio, especially in a belief where this lower for longer return environment probably going to start happening for most developed economies here in the foreseeable future, just given the rise that we've had in the recovery of last year, and certainly the past few years, not a bad option to look over that intermediate long term to things like emerging markets to get that better return profile within a diversified portfolio. An interesting statistic that I'll throw out there, just from a China A economy perspective, if you compare China A to the United States, in the US over the next 10 years, it's expected that we will add about 20 to 30 million new smartphones in the US economy. So that's good, right? 20 more people getting an iPhone or a Samsung Galaxy, consumerism, et cetera. Same time period for China, the expectation is 750 million new smartphones coming online. So what's the greater opportunity for consumerism, the US or China? I think that's a tremendous bullet point to think about that growth opportunity and the rationale for owning the emerging market space.
So we talked about how China is specifically a larger portion of the emerging market space. Speaking of headline risk, let's talk about some of the regulatory issues that are always first and foremost when you turn on CNBC or Fox Business, whether it's China threatening to delist U.S. companies, whether it's Ant Financial's IPO being blocked by Chinese exchanges. Is that a real threat? Is it overblown? Is it, financial media doing what financial media does? Speak to us about some of the headline risk and geopolitical risks that we face with China.
I would say from a media headline perspective, we could have a whole podcast series on the challenges of navigating the media landscape, and hopefully there are some people that undertake that effort. Look, I agree. I think headline risk is part of the challenge. It's not just vaccine headline risk; it is geopolitical headline risk. The tough stance that the U.S. has started under the Trump administration towards China, it will continue. I mean, even if you look at both sides of Congress, people want to preserve kind of American exceptionalism and economic heft, and that's there's an okay and a not okay way to kind of go about those things. But regardless, the stance and the firmness towards China are going to remain intact. I think what we have to do is divorce from the headlines, which is more of a, let's lambast the China economy headline, versus it's very specific towards things that are more state-owned enterprises with specific ties to the Chinese military, which is totally different than the newcos that the marketplace has evolved to. And from our perspective, we have divested in our China A portfolios from those entities per the administration's request. We're still outperforming the beta of the market because it's not, 75% of your opportunity are non-state-owned enterprises in that marketplace. So I think as more information democratizes on how to invest in these spaces, I think some of that kind of anxiety towards it will eventually abate. But the other thing that I would say is what benefits our process and theoretically any active manager is you approach it with a heavy dose of skepticism. What we don't do within my group at Systematic Active Equity at Blackrock, what we don't do is say, here's the government related data. Let's take that and use it from an investment perspective because it's inherently flawed. I mean, there is no way you can tell me that 0 people have caught the coronavirus in mainland China over the past 9 months, but data will tell you that that is true, right? So what do we do to look past that? Alternative data, big data, machine learning, it gives us a degree of certainty amid the uncertainty of misinformation. So how do we gauge economic activity in China? I'll tell you right now, it's not PMI numbers coming from the government. We are getting satellite imagery across the country of China, measuring the amount of reflective surfaces we're capturing off the ground. The more reflective surfaces on the ground, that's glass, that's metal, that's cars, shipping, autos, right? Construction materials, an overall signpost of economic activity. What companies within China are related to those regions that are showing relative stronger economic activity to others? When the pandemic was first starting to loosen back up and things were reopening in China, what we started to do is, can we learn cases or lessons from the China experience to the rest of the world? I think one of the benefits that my team has is we run strategies across every discipline you can think of, not just emerging. So we wanted to learn from experiences in China as it was reopening so that we could learn how we should invest globally. Well, the way that we were doing this is we were picking up GPS data. So were we seeing more cars on the streets or not? And that gives you a true sense of the recovery. If things open back up and they're like, we're back to normal, but you see no cars on the road, they're still locked down despite the headlines saying that things are back to normal. And what we noticed was a very unique trait that started to emerge last year, which was, China was back to work, but not yet back to normal. You actually saw more cars on the road last year than in any other year prior. And what they were doing was taking their savings and buying cars because they didn't want to take mass transit because of the virus. So headlines during May, June, July was that Chinese consumerism was really strong, but it bifurcated, right? It wasn't that everything was recovering nicely. They were very selective in how they were spending their money. We were able to capture that in real time with things like mobile payment data, credit card transactional data, and GPS data. So I go through this kind of discipline of how we use information because you have to do that so you can ignore all that white noise of the media with which to make the most informed decision in a particular market.
So if we shift gears a little bit, and this isn't going to be talking about China specifically, but back to the overall EM concept, we're at a moment in time right now where the US dollar is fairly weak compared to historical averages. Could you just briefly explain the relationship between EM and the US dollar as it has been historically, and how you see that progressing moving forward as well?
So the dollar is weak, which is also good for emerging markets, right? A lot of countries issue dollar-denominated debt. From a hard currency perspective, it gives them a better funding source. And so as the dollar remains weak, that is going to be another form of liquidity provision that is providing a tailwind to emerging markets. If that dollar cost begins to get back up, it does make and put some strains on emerging economies. There is a correlation there to be mindful of. I would say, however, over the past couple of years, it hasn't been as strong as a correlation as what has been kind of historically observed. And I think that speaks more towards investors being much more specific in their allocation decisions rather than buying the overall complex. And to me, Goldman came up with the BRICS. It was Jim O'Neill, right? Came up with the BRICS nomenclature years ago, and everybody was saying you just buy the complex. You buy the complex. So as things have developed, you have, just like everything else, you have clear winners and clear losers. And so certainly a stronger dollar, while it gives a negative headline if a stronger dollar were to emerge for the emerging markets overall, it's really only going to hamper some of those in a more meaningful way. And that, once again, the active dollars are going to move to the areas that are going to still thrive in that environment. So it definitely feels like we're in a place in time after the global financial crisis. We're a little bit more of active and discretionary management. It's coming back into vogue to kind of identify specific opportunities, because it's definitely going to be an unequal distribution of some of these historical effects.
Now, I wasn't even going to bring this up, but it kind of reminded me what we were just talking about. Here in the United States, our investors, I'm sure, tune in and they see headlines of government stimulus, low interest rates, these different things that our Federal Reserve Bank is doing to provide tailwinds to the economy, to the stock market, so on and so forth. I think it's kind of lost on a lot of people what's going on with different central banks around the world, specifically in EM sectors and EM countries. Can you give us an overview of maybe the level of stimulus that is being provided across the globe, specifically in the EM area?
So what's interesting is, look, the EM emerging markets went through a massive crisis back in the late 90s, and the lesson they learned from that was to stockpile reserves. So they have much more bullets in the gun, so to speak, to handle any sort of near-term domestic economic challenge than had ever historically been observed. And if you look at one of the things that folks were worried about is, if you're loosening more in developed economies, what does that mean for capital flight? Are they going to leave emerging, go to develop to kind of ride that sentiment wave from a risk asset perspective? But the reality is they're able to actually go in with reserve. They have so much reserves to go in and defend their own economies. They have much more from a fiscal and a monetary standpoint than had ever really been historically observed. So it does put it a little bit more on a level playing field with what we've been doing here in quote unquote the West. Once again, it's a different playing field than what was observed in the previous 2 decades with what we're seeing today. They're quick learners. These economies are quick learners from some of the challenges of the late 90s and certainly the GFC.
So thus far, we've been talking about emerging market equities pretty exclusively. Let's shift gears a little bit and talk about emerging market debt here in the United States. And for our investors, specifically and investors all over the place, one of the issues that we're running into is you've seen a good amount of capital appreciation from the fixed income portion of your portfolio over the past, we'll just call it X amount of years, because interest rates have been falling steadily. We're now at a place where interest rates are low. They're expected to remain low. You might see a little bit of creep, but there's a lot of retired investors, conservative investors, who have no choice but to have fixed income in their portfolios, because it serves as the ballast when the stock market goes a little bit haywire. When you see that volatility, we're just not going to be able to get a whole lot of income. And we keep hearing the idea of emerging market debt being a great diversifier for the fixed income portion of that portfolio. If you could speak to the EM debt situation, again, present, maybe even give a little bit of a background, and then moving forward, of course.
So a couple things I would highlight in this question. The first word is creativity. I think going forward, portfolio construction to thrive and to help insulate portfolios, you have to have a very creative and dynamic approach to creating an overall portfolio. And the reason why I say that is, back in 2001 tech bubble, if you had a total return bond fund, you were golden, right? You had yields at 7%, you had a flight to quality protection. It was the perfect insulation for a portfolio. Well, yields are consistently at all-time lows. You have to get more dynamic and rethink a little bit of your fixed income portfolio. You don't ignore it. You just say, how can we complement it? I think there's two ways with which to do that. You either get pretty creative and a flexible approach for how you want to invest across the fixed income asset classes, or you can look at alternative investments that have and limit kind of equity beta. So you can say, I'm not going to replace a fixed income beta with something that's going to give me equity risk. You do it on the alternative side. And look, that's been a challenging place to be, but it is something to consider going forward. I would say this about emerging market debt. Emerging market debt is extraordinarily correlated to emerging market equity risk. It's actually a 0.7 correlation. So that movement of EM equities is the exact same movement as EM debt. And I say that because it's a good diversifier for an overall fixed income allocation. However, it's also a very kind of growthy look and feel for equity allocation of EM as well. So the same risks persist. And we see this kind of time and time again. If you have that headline risk and kind of growth comes under question and people are worried about the overall recovery, EM equities and EM debt are both going to take it. Now, the one advancement in EM debt that's been pretty interesting, and this helps to also negate some of that dollar question that you had earlier, Jordan, is a lot of economies, because they're in a much better position, they're issuing debt in their own currency. So local EM debt funds are relatively more insulated from dollar moves, but they're still tied inextricably to EM equity growth moves. So it helps remove some of that risk. That evolution of the market, I think, is quite important. But part of it is also thinking, one of the questions I used to get from an investor perspective is, what's the right allocation between EM debt and EM equities? And the response I always gave them is, if you have a good manager, debt or equity, just kind of go in that direction because they're so closely tied from a performance perspective.
That's a great answer. I usually end with debt because that's where the listeners probably start to doze off. Everybody likes to talk about equities. Nobody likes to talk about bonds ever. So I'll take this opportunity to thank you both. Again, Blackrock is a super close partner of ours. We get a lot of our information from you guys. Thank you both for taking the time. And like I said, this is going to be an ongoing series. So depending on what happens in the world and in the marketplace, hopefully in a good way, we'll have you back to discuss some positive developments.
Thanks for having me. I appreciate it. Hope everybody stays safe out there.
Yeah, thank you for your time.
All right, guys.
Appreciate it.
Take care.
Take care. Have a great one.
Take care.